Hi, I'm John Persinos, Editorial Director of Investing Daily. Welcome to my latest video presentation from Mind Over Markets for Monday, December 19. To view our full range of publications and trading services, visit our website at investingdaily.com. Also visit the website of our subsidiary, streetauthority.com. The combination of recession fears, rising interest rates, and corporate earnings deceleration has sent stocks tumbling. So much for a Santa Claus rally. The main culprit for stealing the Christmas hopes of investors, the surprisingly Grinchian comments of Federal Reserve Chair Jerome Powell. Equity markets fell for the second consecutive week as Wall Street sentiment turned lower in the wake of the Federal Reserve Open Market Committee meeting December 13 through 14. The hike in interest rates of 0.50% was expected, but Powell's stern remarks at the post-meeting press conference spooked investors. See the following chart. The Dow Jones Industrial Average fell 1.7%. The S&P 500 Index fell 2.1%. The technology-heavy NASDAQ fell 2.7%. And the international MSCI EAFE fell 0.9%. The NASDAQ is the worst performer, down 31.6% year-to-date. Crude oil prices rose 4.6% for the week, though, amid persistent supply constrictions. As is often the case, Powell's public remarks tanked stocks. He said, "We continue to anticipate that ongoing increases will be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time. In addition, we are continuing the process of significantly reducing the size of our balance sheet. Restoring price stability will likely require maintaining a restrictive policy stance for some time." We're seeing that the bear market still has bite. Also undermining stocks is the latest retail sales report. Excluding autos, retail sales in the U.S. shrank by 0.2% month over month in November of 2022, the worst decline since December last year, and defying market forecasts of an 0.2% gain. This unexpectedly weak retail sales report showed that the Fed's tightening is starting to negatively affect consumer behavior and the economy, further stoking recession fears. To make up for lost time and get ahead of the curve on inflation, the Fed has initiated this year its steepest tightening in 4 decades. You'd have to go back to the infamous Paul Volcker era of the late 1970s and early 1980s for a series of rate hikes that are more dramatic than what we've seen in 2022. But it's not just the Fed. Central banks around the world are grappling with global inflation, aggressively hiking rates in their respective countries. Global tightening is likely to continue through the first quarter of 2023. Add China's COVID woes to the mix, and investors are worrying about a recession with global reach. Bearish sentiment is emerging despite better-than-expected Consumer Price Index (CPI) inflation data for November, which showed that inflation is cooling down. CPI inflation data for November came in below expectations, with headline inflation of 7.1% year over year compared to expectations of 7.3%. Core inflation came in at 6%, also below forecast for 6.1% and lower than last month's 6.3%. The Fed's dot plot released last week also surprised the markets. An estimate of where interest rates are headed, the dot plot indicated a peak federal funds rate of 5.1% in 2023. This rate was slightly above market consensus of 4.8% to 5%, heading into the December 13-14 FOMC meeting. Fed Chair Powell emphasized that while recent inflation data has been encouraging, inflation remains elevated and well above the Fed's 2.0 target. Powell went out of his way to say that it was too soon to discuss rate cuts. Powell's overall message: curb your enthusiasm. The inflation battle still has a long way to go, even if it means causing economic pain. As you can see from this chart, the federal funds target range currently hovers at an upper limit of 4.5%. The Fed and markets seem to be converging around a 5.0% peak rate. Here's the good news. Once we've reached the peak in the Fed funds rate, historically the next 12 months are positive for the stock and bond markets. Now let's look at the week ahead. The economic calendar leading into Christmas is a busy one. NAHB Home Builders Index Monday, building permits and housing starts Tuesday, Consumer Confidence Index existing home sales Wednesday, initial jobless claims and index of leading economic indicators Thursday, PCE index, disposable income, consumer spending, durable orders, consumer sentiment, and inflation expectations, and new home sales Friday. The first few months of 2023 are likely to be soft for the economy, corporate earnings, and stocks. That said, we still might dodge a recession, especially in the context of robust jobs growth. The back half of 2023 still holds enormous promise. What's more, considering the declines we've already endured this year, we're unlikely to see a new dramatic downward leg in the stock market next year. As inflation continues to cool, central banks will have less justification for hawkishness. In terms of portfolio allocations, value and defensive plays should dominate your stock sleeve. But as 2023 unfolds, market leadership may transition to more cyclical sectors that dominate during a recovery. Well, that's it for now. Thanks so much for watching. And if you have any comments, questions, or feedback, don't hesitate to send an email to me at mailbag@investingdaily.com.